Hey, what's up everyone? My name is Patrick. Hope you guys having an awesome day. In my last video, I talked a little bit about the power of compound interest, how the sooner you start investing, the more time you have on your side for your money to grow and start making new money, and the goals required for you to become a potential millionaire. So if you haven't seen that video, please go check it out. Just as a little disclaimer, I'm not a financial advisor or qualified. These are just my personal opinions on things I've learned over the years, which I hope to share and help people achieve their financial freedom dreams. Now, from our past couple of few videos, we have some basic knowledge of the different asset classes, their risks, and the power of compounding. We can start talking about the various brokers and associated fees, and why it's important to take care choosing your broker. And as I'm UK based, I'll be covering some of the ones that are popular in the UK and the ones I use, covering the different benefits of each. The three brokers I like to use for investing are Trading212, Hargreaves Lansdown, and eToro. There are a bunch of other brokers in the UK listed below, as well as even more, but I've not used them, so I won't be covering them in detail. Most UK major banks also offer investment advice and platforms to invest through your bank. And there's a lot of articles online comparing the benefits of each as well as more detail into them. But here's a little rundown summary comparing the three brokerages I use and the experience I've kind of gained from using them. So let's start by talking about the different fees. So Trading212, they charge 0% commission, but they do charge stamp duty tax. And if you haven't heard what stamp duty tax is, it's a tax you have to pay towards the government when purchasing shares. So automatically you're kind of starting behind. So you really have to be confident in your investment. It's usually a very small percentage, but it does add up if you're buying a large number of shares. For Hargreaves Lansdown, they do actually charge quite a considerable amount of commission for individual trades, £11.95 for individual trades. And if you're buying overseas shares, you have to pay additional forex fees, as well as the stamp duty tax if you're buying UK shares. eToro is kind of probably the most efficient in terms of fees. They charge 0% commission and they cover all of the stamp duty costs. Those are for like individual stocks. When looking at funds, for Trading212, the management fees are taken usually when selling the asset. For Hargreaves Lansdown, they can vary depending on the provider. Ideally, you want to be aiming for a low percentage of the fees towards the fund, as this means less money going out of your account to manage the fund and more money staying in your pocket. And eToro once again comes ahead in this regard as they cover the management fees themselves. And I'll go a little bit into this, why they're able to do this. So the pros for Trading212 that I found using it, there's no commissions, orders are filled pretty quickly, it's pretty intuitive to use, they have a mobile app which is very fun, and you can also get a virtual practice account, which is very useful when starting out investing, as you can kind of have a trial and feel for how the platform operates. And I do recommend strongly getting a virtual practice account if it's possible with your broker, as it's very helpful to kind of just build your knowledge and see how you can go about making an order to purchase shares before using real money. For Hargreaves Lansdown, their pros, they are very established. They have really, really good customer service. If you try calling up some of the other brokers, you can wait for quite a long time, but I've never had any issues getting contacts with Hargreaves Lansdown. They also have a larger range of assets available, and they offer both a stocks and shares and lifetime ISA in comparison to Trading212 stocks and shares ISA only. The pros for eToro are the very low fees. They cover a lot of them, and they have a very helpful and intuitive copy traders option, as well as offering a practice account. And if you're just getting started, the copy traders is very kind of unique and a fun way to get started, because you literally can copy how other people trade in the meantime whilst you're learning, and your money can start making you money. Now I'm going to talk a little bit about the cons of each. So the cons of trading 212 is their customer service is very slow. I had an issue once and it took them almost 2-3 months to respond. So if you kind of want that peace of mind of getting through to people very quickly, I would recommend Hargreaves Lansdown, as well as occasional server issues, especially when market opens. The markets in the UK typically open at 9 a.m. and for America's markets they open 9:30 a.m. their time, which is 2:30 a.m. our time. And I've noticed a bunch of times that there's been quite a few server issues, especially during that time, as there's a lot of people looking at the app. Hargreaves Lansdowns, they're very expensive for individual shares, and when trying to sell a fund, they are kind of very slow to process. It's taken me 2 days before to kind of sell something, whereas on Trading 212 and eToro, it's almost instantaneous. As well as they don't offer a practice account, that's one quite big drawback. And finally, the cons for eToro, they charge a $5 withdrawal fee from the account, whereas the other ones do not charge a withdrawal fee. And they offer large spreads, which is kind of how they cover their management fee. So when I talk about spread, it's essentially the difference between the buying and selling price. There's always a difference because that's how these brokerages make the majority of their money. So for example, if you have a stock that's worth $500, in order to buy it, it might be $500.05. In order to sell it, it might be $499.95. And that kind of 10-cent difference on each share and trade is how they make most of their money. Nextly, I wanted to talk about ISA benefits and why you kind of should be trying to maximize these. And for the brokers, actually one more thing I wanted to mention is they're all kind of covered and protected by the Financial Services Compensation Scheme, and that means all your funds are protected up to £85 per person, up to £85,000 per person, should the broker face insolvency and fail. The majority of brokers do actually have this kind of same protection, but it's just good to double check. So back to ISAs, I just wanted to cover these and why I think it's really, really beneficial to maximize your contributions. So an ISA is an individual savings account, and it's just a form of investment/savings account that you never have to pay tax on. This applies also to capital gains tax. You can only ever put in £20,000 per year spread across any types of these ISA accounts. And there are 4 main types of ISA accounts, which I've listed here. The first is a cash ISA, which is primarily used for large amounts of cash savings. And the benefits to this are you don't have to pay any interest on the interest that you earn. You don't have to pay any tax, on the interest that you earn. And the drawbacks are interest rates typically can be lower than inflation, and your money is typically locked into the account for a year or two. The next ISA, which I actually not previously heard about, was an innovative finance ISA. The primary use of this ISA is lending money to other people or businesses. And the benefits to this is, once again, any interest earned from lending money isn't taxed. And you kind of see the theme here where all this money is tax-free, or each has its own benefit. The drawbacks to this is typically they're a bit more risky, as you might not always recoup your investment if people can't pay you back. The next form is lifetime ISA, and I had never previously heard about this one until 2 years ago, and I wish I knew about it sooner because it's really good for longer term saving, especially for a house or for your retirement. And the benefits of this is because the government give you 25% incentive on any money you deposit into the account. This means up to £1,000 free per year. This is capped at £4,000, which is why it's only £1,000 maximum free per year. And it's kind of an incentive for you to deposit money and invest. The only drawbacks to this is the money is locked in the account, and the only way to unlock the money is for your purchase of your first home or until you're 60 years old. So therefore, if you do need your money in an emergency before that time, withdrawing the money means you have to pay a 25% penalty. So you lose the bonus and potentially some extra. So it's not really advisable to have this kind of ISA account if you might potentially need the money in the near future. The last ISA account is a stocks and shares ISA, which is very primarily used for investing into individual stocks and shares as well as funds. And there's quite a few benefits to this because once again, it's all tax-free on capital gains. You don't get any tax on interest earned on bonds and no tax on dividend income. So if you do want to go down the dividend route of investing, typically after £2,000 worth of dividends, you get taxed in other accounts. But if your money's in the stocks and shares ISA, you get no tax on that. And it's no cap. So you can go up to as much dividends per year. The only drawbacks to this is the investing in stocks and funds always carries some form of risk and the price can fluctuate quite drastically. So I hope you guys learned something from this video and enjoyed watching it. As always, hit the like and subscribe if you found this video useful and have learned something. And I'll see you guys in the next video.